This is chapter 11, video 2. Let's launch. All right, so in this video, we're going to do describe the general characteristics of gains or losses recognized on property dispositions. And then we're also going to talk about the tax treatment of 1231 gains and losses, including the 1231 netting process. So if you take a look at this chart, basically, I mean, we talked about this in investments. Basically, if it's short-term, 1 year or less, and I want you to understand, 1 year or less, it's short-term. If it's more than 1 year, long-term, okay? So this is kind of an expanded thing. I don't remember. I don't think in the chapter 7 videos that we saw this. But in this chapter, I mean, in this thing right here, they actually throw in the property use and trade or business. If it's an investment or personal used assets, short-term capital loss, short-term capital gain, long-term capital gain or loss, and how that gets done. I think that's pretty much chapter 7 right there. So you buy a stock, you sell a stock. You're going to either get short-term capital or long-term capital treatment, depending on how long you held it. Now, when it comes to business, there's two different types of assets. You'll notice that we have the inventory and accounts receivable. So if I sell accounts receivable and I have a gain on it, I'm going to be paying ordinary income. It doesn't matter whether I've held it for more than a year or not. It'll get reported a little differently, but the effect is pretty much the same. Now the inventory, same thing. If I sell inventory, that's the same treatment. Now, some people might say, why do accounts receivable and inventory get that treatment? We talked about this in a previous video. But basically what happens is that, with inventory and accounts receivable, the idea is that this is something that's going to convert to ordinary income if it were to go through the normal process. And so what the IRS doesn't want you to do is they don't want you to be taking things that are supposed to be ordinary income in nature and converting them to a capital nature, and trying to get the preferential rates. And so this is something that they do, and that's kind of why it follows tax theory. And if you think about it, look, I've had my fair share of picking on the IRS. But this is where I actually kind of agree with this. I think it's logical. It makes sense. If I have an accounts receivable and I pick it up and I'm going to get ordinary income, well, I want to pay less in taxes. I'm going to go factor my accounts receivable and get some money off of this. If that ends up happening, you've got to do this with that. You won't get that type. You shouldn't be converting it from ordinary to capital in order to get preferential treatment. Now, if you think about it, though, is this a good thing or a bad thing? Because normally, if you factor receivables, what are you going to get dollar for dollar for them? No, more likely than not, you're going to take a hit. And because it's ordinary in nature, guess how the treatment is done on this? It goes against ordinary income. So if I lost $50,000 on factoring, say $400,000 of accounts receivable, I get to take a $50,000 loss immediately. That's the way it is. And that actually is not necessarily a bad thing. Inventory too, if you're going to dispose of inventory in a non-traditional process of I buy inventory, I sell it in a retail process, blah, blah, blah. Maybe I do a clearance sale. Maybe I'm like, I've got pallets of, very good example. I think that, there's a new Tom Cruise Top Gun 2 movie coming out. I think it's going to be a big hit. So I go out and I buy $1 million worth of Top Gun merchandise, and I'm going to sell to people. And all of a sudden it comes out and it's a bomb. I need to get rid of this inventory. I can't hold this anymore. So I sell it at a massive discount. Again, I was going to convert it into ordinary income, as a result of which would I sell it at a loss, ordinary income. All right. So then there's but now we get into property use, business, trade or business. And when we're talking about this kind of property, we're talking about machinery, computers, desks, real property, land, pick it all out. And so when you kind of take a look at this and you're seeing that, you want to make sure that that you've got this thing classified correctly. But most of the time, if it's ordinary, if it's short term, it's going to be ordinary. And then of course, if it's long term, it's going to get 1231 treatment. You notice that does not say capital gains. Now, it says under there, if you take a look at the little cross on the bottom, it says, as we describe later in this chapter, gain or loss is eventually characterized as ordinary or capital long term. And we'll talk about what those rules are. So ordinary assets, we've already talked a little bit about this. Example, inventory is, examples of ordinary assets, inventory, accounts receivable. I'll be honest, when I do this most of the time, usually you're dealing with inventory and accounts receivables as the ordinary assets. And when we get to partnerships, we don't talk about dispositions of partnerships in this class. If you want to go to the master's level class, they'll talk about that. You'll talk about what's called hot assets, and the hot assets are going to be, it's not, yeah, I know, but mind you, I grew up in a poor side of Los Angeles. Hot assets meant something completely different than it does in accounting, but in inventory, hot assets are because they're saying, hey, look, this is something that's going to be ordinary income as opposed to something else. And, so we'll just leave it at that. Capital assets that are held for investment, for production of income or for personal use. The qualification of capital asset depends on what's the purpose for the taxpayer. So, and there's some truth to that. So something that could be held as inventory could also be a capital asset. So like, say, for example, I'm a car salesman. I sell cars. That car, when I sell it, is an inventory item. Even though, I don't think anybody would disagree that a car could be a capital asset for another business. But in a car dealership, that's what's going to happen. If I take land, divide it up, and sell off parcels of that land after I've developed houses on it, that land and the houses is inventory. I don't get to treat that as capital gains. I'm a dealer in real estate, as a result of which I get ordinary gains and ordinary loss treatment on those assets. So both individual and corporate taxpayers prefer capital gains to ordinary. I would say capital gains they prefer. Corporations, as we're going to talk about when we get to the corporations class, may not necessarily like capital treatment on some stuff because if there's a capital loss, their ability to take capital losses is significantly restricted compared to individuals. And so sometimes, going the capital loss route is not the way they want. This is a review of the capital gains and losses. I'll let you take a look at it. This is what happens for individuals and how that gets treated. This is how C corporations, like we said, no preferential rates, taxes ordinary rates. And then there's no offset against ordinary income. And that's part of the problem. Again, you see there's more limitations than there are preferential preferences on this. So that's why sometimes C corporations say, hey, it says that, the slide says they prefer capital gains to ordinary, to ordinary. Yeah, that's generally true because once it's taxed, it's done. But if you have a loss situation, it can, obviously losses are good because you're not getting taxed on it, but losses also have a, like I said, back 3, forward 5. If you don't have any capital gains to offset those losses during that time, you're stuck like Chuck. Okay. So then we have here, the 1231 assets. So 1231, it's code section 1231 is a depreciable asset used and land, used in trade or business and held for more than 1 year. If a taxpayer recognizes a net 1231 gain, it is taxed as a long-term capital gain. If it's a loss, it is treated as ordinary loss. 1231 used to be what I would call, and actually I think still is the best of both worlds. If you have a gain, long-term capital gain. If I have a loss, I have an ordinary loss that I can take against my ordinary income. It's going to be something that I'm going to have as a major benefit. It encourages businesses to go out and purchase property in order to turn it into business assets, and then later on convert that to cash when it's no longer useful for them. Because if you think about it this way, why would Congress want to encourage that? Well, say, for example, IBM uses a machine to develop computer chips, and the machine is no longer going to be viable for them because they're going to be retooling, they're going to be doing a new type of computer chip. Maybe I am a company that knows IBM, and I've decided that I want to get into the computer chip manufacturing, or maybe I do computer chip manufacturing, and I would like to do replacement chips for those IBM machines. I could go buy that machine from IBM. It comes to me. It's cheaper. I don't have to pay for all the development costs and everything else that IBM probably had to do in order to manufacture it. But at the same time, so I get something less expensive. I produce a product. I sell that product. It spurs economic growth. That's a good thing. IBM gets the loss because they spent all these millions of dollars building that machine, and then they sell it to me for maybe $200,000. So they get a loss on that. Yeah, that's great that they get that loss. But in exchange for that loss, again, big balance sheet here. You got to think about that. The Congress and the IRS is more concerned about spurring economic growth. And they know that by me buying the machine, and maybe I buy it for less, I'll have less depreciation. Okay, fine, whatever. But I'm going to have much better economic performance out of it because I may be lean, mean fighting machine, whereas IBM is kind of big blue. And, you know, when they say big blue, you know, or they're kind of like an iron marshmallow, you know, they're big, but they're tough on the inside. Okay. Taxpayers could benefit from the strategy. Okay, so calculating net gains losses. There's a strategy for actually getting rid of 1231 assets. You could accelerate the losses into year one. You can defer gains until year two, and then you know the purposes of the netting, characterizing of gains and losses due to the 1231 netting process. The netting process. So what ends up happening is they say, look, if you have a whole bunch of losses this year, and say you do this. You do the losses, and say I have $50,000 of losses this year. And I also have another piece of property that's going to be sold for a gain, but I decide to wait till next year to sell it. What have I effectively done? I've gotten an ordinary loss today, and tomorrow when I sell that, not tomorrow, but next year when I sell that other property, I will actually get capital gains treatment. Okay. So what ended up happening is they said, look, we're not going to allow you to have these abusive rules. And usually the way it happens is Congress passes a law, people go out and they find ways to get, creative ways to use these laws. And then Congress kind of go, well, it's not really what we wanted you to do that with. So we're going to make a rule in order to change that. So they came out with this rule, 1231 look back. So it's non-depreciation recapture rule. Basically what happens is that you have to look back. You have to look back. If you have a gain, say I have a gain. So take that scenario. I sell something for $50,000 loss this year. Next year, I sell something for a $50,000 gain next year. What ends up happening is Congress says you got to do a look back in order to take a look at it. And that $50,000 gain is no longer going to be given to you at capital rates. It'll be given to you at ordinary rates because we already gave you a benefit in the previous year. So this is something that you might want to take care of. Now, what's the way that you can do this? One way you could do it is you could take the gains this year and forward it to next year, when you get the losses, because it's a look back rule, not a look forward rule. The problem is that you have to know what these rules are and how it helps out. And that's also going to be why it's important as a tax professional in order to get that set up. So this basically is netting of 1231. This is and I'm sorry, my board is like really small. So this is the sale of the business assets. It's kind of a flow chart. These flow charts can be very useful. If you do this often enough, you've got the flow chart pretty much memorized. I like keeping, I'm going to tell you this one thing I do love about this textbook. They have a great amount of tools when it comes to managing the flow charts. I think there's a lot of flow charts that can be very useful. Taking that, printing it, print it on some larger sheet of paper. I don't recommend necessarily on standard 8.5 by 11. This is one thing I like about when I lived in Japan, and I guess they use the British system. But paper it's not 8.5 by 11. It's like A3. You can go A2, which then cut in half goes to A3, cut in half goes to A4, cut in half goes to A5. You want to get this to where it's big. And I would probably say 11 by 17, which is ledger. I'd keep a couple of those, laminate, fold, and then that way, if you're ever running into a situation where you're like, does this qualify for 1031 loss? Until you get comfortable with it. And like I said, about 2 or 3 years into the future, you're going to have this stuff rocked out. So you probably only need this for a little while. Reason why I kind of like doing the laminated, it keeps it protected, and then you can have it to where it folds. And then also, if you have like erasable markers, you can write all over it if you want to say, yeah, this part qualifies, blah, 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 and then you just wipe it off. I actually like it. When I was in the military, I used a lot of laminated type stuff to do as study aids because I could write on stuff and then erase it. So it was a good deal. Here's where they talk about the netting process, and we'll, I'll let you take a look at that, and we'll kind of flow through with that. All right, so this is a summary of the Teton gains and losses, in the property disposition. you know, again, so this person, what they've ended up having, you know, and we'll talk a little bit about what 1245 gain is here later on. But this is basically part of the netting process that they had for the example that they had in the book. You can kind of take a look at it. I'm not going to go too far into it because this video is getting long already as it is. So, let's see. That's all I got to say. All right, guys, it's been wonderful having you in class. I look forward to seeing you in the next video. And, you know, I hope you guys are probably plugging this out. Make sure that you're attending the weekly office hour sessions. And also make sure that you're taking good notes so that when you guys take exam 2, you're going to kick it and do very well with it. And also make sure you show up to the review sessions if you haven't done that before. All right. Again, thank you very much for watching. Hope to see you in the next class.